exercise 12 on page 108. For this exercise, we're asked to do three different things. The first is to identify each account as an asset, liability, or equity account, and that's just a continuation from chapter 1. That is what we focused on with doing the transactions where we had to classify this. Is this an asset, is this a liability, or is this an equity? In order to classify it correctly, you have to know the definition of asset, liability, and equity accounts. The second requirement is to identify whether the account is increased with a debit or a credit. Debit is where we're accounting for things that are recorded on the left. Credit is where we're recording things on the right of our T account. And the third thing is to identify whether the normal balance is a debit or a credit. The normal balance is going to be how a particular account increases. If a particular account increases as a debit, then the normal balance is going to be a debit. If a type of account is going to increase as a credit, the normal balance is going to be a credit balance. When we're looking at debits and credits, assets are going to increase as a debit and decrease as a credit. Liabilities are going to increase as a credit and decrease as a debit. Equity accounts in general are going to increase as a credit and decrease as a debit. When we look at expenses and dividends, because expenses and dividends are going to affect the retained earnings, and we talked about how retained earnings is going to go down because of expenses and dividends, then the expenses and dividends are the opposite of a normal equity account. Expenses and dividends are going to increase as a debit and decrease as a credit, just like an asset. So assets, expenses, and dividends increase as a debit, decrease as a credit. Liability and equity accounts increase as a credit and decrease as a debit. So requirement 1, again, is just basically from chapter 1. So we have interest revenue. Interest revenue is a revenue account. As a revenue account, it is going to be an equity account. The revenue will affect retained earnings. Retained earnings is an equity account. As a normal equity account, the interest revenue is going to increase as a credit. When an account increases as a credit, it's going to also have that as a normal balance. However the account increases, that is the normal balance. Accounts payable. Accounts payable is something that the company owes, so it is a liability. It is an obligation the company has to satisfy sometime in the future. As a liability, the account is going to increase as a credit. As the account increases as a credit, we are looking at it is going to have a normal credit balance. Common stock is an equity account. It is a normal equity account. Equity accounts are going to increase as a credit. As an increase in credit, the normal account balance will be a credit. Office supplies are things that the company owns, things that the company is going to use in order to generate revenue. So office supplies are an asset. Assets are going to increase as a debit. As assets increase as a debit, the normal balance is going to be a debit. Advertising expense is an equity account. Expenses are going to affect retained earnings. As we account for the equity account, we're looking at the expense causes the equity account to go down. However, if we look at the expense itself, the expense itself is going to increase as a debit. Expenses and dividends increase as a debit because they cause retained earnings to go down overall. Because the expense is increasing as a debit, it has a normal debit balance. Unearned revenue is a liability account. Unearned revenue is where the company has received cash with the assumption that they're going to provide a service at a later date. So it may be a magazine subscription where the company is selling magazine subscriptions. The company may receive $120 for the year, but they're going to send the magazine out on a monthly basis. So the revenue is only earned once the magazine has been shipped to the customer. The magazine subscription is going to be recognized as revenue on a monthly basis, but the cash received in the beginning is going to increase cash as an asset, but the unearned revenue results in a liability to satisfy this magazine subscription. So unearned revenue is going to be a liability account, and as a liability account, we are looking at a liability increasing as a credit. If it increases as a credit, that's the normal balance. Prepaid rent is where you prepay for rent. This is where you may pay for a year's rent in advance. You don't actually stay in the building all year long at the very beginning. At the very beginning, you haven't used that rent at all. So if it has not been used yet, it is going to be used in the future. It is prepaid. So with rent, you have to pay attention to the timing. Is rent paid in advance? Because if so, it's prepaid. Prepaid rent is an asset. As an asset, it's going to increase as a debit. If it increases as a debit, it has a normal debit balance. If the rent is paid for rent that has already been used, it is rent expense. So pay close attention to timing of, is the rent to be used? If it is to be used in the future, it is an asset. Utilities expense is an expense account that is going to affect the equity of the company. Just like we looked at the advertising expense in E, we are looking at the expense is going to increase as a debit, which means we're going to have a normal debit balance. Dividends are an equity account. They are going to affect the total equity of the company, but dividends are going to act like expenses as far as how they increase. They're going to increase as a debit. If they increase as a debit, they have a normal debit balance. Service revenue is an equity account that is a normal equity account. Remember, when we're looking at retained earnings is affected by revenues, expenses, and dividends. Revenues are going to increase retained earnings. Expenses and dividends are going to reduce retained earnings. Because revenue is a normal equity account that is treated just like a normal equity account, it's going to increase as a credit. If we increase the revenue as a credit, it will have a normal credit balance. Some of this makes more sense than others. If you think of cash, we were not asked to actually look at cash, but cash is an asset. Assets are going to increase as a debit, which means cash is going to have a normal debit balance. If you have cash, it is a positive amount. You cannot have a negative cash amount. Now, realistically, you can have a negative checking account, but you should not do that, so we're not going to discuss that. When you're looking at cash, you either have cash or you don't. You cannot say, I negatively have cash in my pocket. You either have cash in your pocket or you do not. So if we're looking at the normal balance, we're saying, what should we have at the end of the period? At the end of the period, if we have cash account, it should have a debit balance because it's an asset and it's going to increase as a debit. Therefore, I should have an ending debit balance as my normal balance.